is starting to sniff this out. The yield on a 30-year U.S. Treasury today rose above 4.9%. We're at 4.92%. The yield on a 10-year is 4.69. So these are the highest yields that we've had since the Fed started cutting rates. In fact, you have to go back even further than that. But again, this does not surprise me. This is exactly what I was saying was going to happen even before the Fed started cutting. But I said that when the Fed did cut, that would be market ended in 2020, with the COVID, blow off top in bonds and bottom in yield. But we are moving substantially higher. Mortgage rates now are back above 7% and rising. They're going to be above 8% pretty soon for a 30-year fixed rate mortgage. But they're back above 7. Credit card rates are 25%. They're going to keep going up. Now, we got more bad news. I mean, forget about the fact that the mainstream media is ignoring this boom in commodity prices. I mean, which is completely inconsistent with the story the Fed is trying to sell. How can they be telling us that inflation is going to come down when prices are soaring? And these commodities, these are input costs. So they're going to bleed in to producer prices and consumer prices, right? They're going to move first, and then you're going to see it going, up the chain. So these are leading indicators. So how could you ignore? The last time we started to see commodity prices surging like this, it was before inflation really ran away. And then in the face of it, the Fed was still claiming that inflation was transitory, even though commodity prices were showing that that wasn't the case. Well, that's happening again. Now they're saying that, inflation's gone and commodities are surging or will cause the inflation. They are the result of the inflation that is already there. The Fed never put out the entire time. And now you're seeing it in these commodity prices. You're going to see it more in oil. Again, one of the reasons that we didn't have a bigger move up in oil when Biden was president, and he's still president for a few more weeks, was his politically motivated decision to raid the Strategic Petroleum Reserve. Imagine where oil prices would have gone or might be now had we never, let loose all that oil. I mean, we didn't have to drill, baby drill. We just tapped. We just sold the oil that we already had. But, that card has been played. Trump is not going to do that. And so we're not going to get, artificially low oil prices. Now, some people think, well, we're going to drill more oil. Maybe, but not until the prices are a lot higher. Because American oil companies are not going to invest in development and more capex for more drilling at $74 oil. They're just not going to do it. It's not high enough, But yes, if oil's back above 100 and it looks like it's going higher, and yeah, we'll probably get some more drilling.
Inflation is the most insidious form of taxation. Unlike overt taxes that governments explicitly impose, inflation covertly erodes the purchasing power of your hard-earned money. Peter Schiff consistently emphasizes this critical point. Inflation doesn't happen overnight. It's the cumulative result of monetary mismanagement. Today, we're witnessing the consequences of decades of reckless monetary policies. Think of inflation like a slow-burning fire. Initially, it may seem manageable, even beneficial in small doses. But once it gets out of control, it's nearly impossible to extinguish. For years, central banks have been playing with fire, using inflation as a tool to manage debt and stimulate economic growth. Yet the current environment where commodity prices are surging is proof that this strategy has hit a breaking point. Commodity prices are a leading indicator of inflation. Rising costs in oil, natural gas, and other raw materials are not just numbers on a spreadsheet. They're the precursors to higher prices across the board. Whether it's food, housing, or healthcare, inflation trickles down into every facet of life. For investors and savers alike, this creates an urgent need for protection, and that's where gold and silver come in. The bond market is flashing warning signs that can't be ignored. With 30-year Treasury yields climbing to 4.92% and 10-year yields at 4.69%, it's clear that the market is adjusting to a new reality. Rising yields indicate that investors are demanding higher returns to compensate for the risks of holding U.S. debt, particularly in an inflationary environment. Why does this matter? Because higher yields mean higher borrowing costs for individuals, corporations, and the government. Mortgage rates, for example, are back above 7% and heading toward 8%. Credit card rates, already exceeding 25%, are likely to climb even further. This creates a ripple effect that slows economic growth and puts additional strain on consumers. For the U.S. government, rising yields are especially problematic. Servicing the national debt becomes exponentially more expensive as interest rates climb. The Congressional Budget Office has already warned that by 2031, all federal revenue could be consumed by interest payments and mandatory spending programs like Social Security and Medicare. This leaves no room for discretionary spending, let alone addressing emergencies or investing in infrastructure. In this context, gold and silver are not just investments, they're lifeboats. Unlike fiat currencies, whose value depends on the whims of central banks, precious metals have intrinsic value. They've been used as money for thousands of years and have survived every economic crisis in history. Gold, in particular, acts as a store of value. When inflation erodes the purchasing power of paper money, gold retains its worth. It's not that gold becomes more valuable. Rather, it's the dollar that becomes less valuable. This distinction is crucial. Investing in gold is not about getting rich. It's about preserving wealth. Silver, often overshadowed by gold, has its own unique advantages. It's both an industrial metal and a store of value. As industries like renewable energy and electronics continue to grow, so does the demand for silver. Moreover, silver is currently undervalued relative to gold, making it an attractive option for investors looking to hedge against inflation. One of the reasons oil prices remained relatively stable during the Biden administration was the release of millions of barrels from the Strategic Petroleum Reserve, SPR. While this move provided temporary relief, it was a political band-aid rather than a sustainable solution. Now that the SPR is significantly depleted, the U.S. no longer has this card to play. This sets the stage for higher oil prices, especially as global demand increases. Rising oil prices don't just affect the cost of gasoline, they ripple through the entire economy, increasing the cost of goods and services. For investors, this underscores the importance of holding inflation-resistant assets like gold and silver. Many businesses are optimistic about a Trump presidency, expecting an economic boom fueled by lower taxes and deregulation. However, as Schiff points out, this optimism may be misplaced. The structural problems in the U.S. economy, rising debt, inflation, and an over-reliance on fiat currency, cannot be solved overnight. If anything, they require painful adjustments that are unlikely to be politically palatable. The disconnect between market optimism and economic reality creates significant risks. Businesses are hiring and expanding based on expectations that may not materialize. When these expectations are dashed, we could see a wave of layoffs and bankruptcies, further destabilizing the economy.
But that's not the environment that people expect. Everybody is talking about $40 oil. Well, at $40, no one's drilling oil, despite the fact that they're ignoring commodity prices. And I don't see anybody talking about it. They couldn't ignore the economic data that came out today. There was a big jump in prices paid in the PMI. It was the ISM Services Index, which was higher than expected. It was one of the only economic data points that was above expectations, although we did get jolts today that was above. But it was at 54.1. But the prices paid spiked up, highest level in 2 years. Obviously, there's a lot of inflationary pressures that have been building, and that spooked the bond market, together with the JOLTS numbers that showed a spike above 8 million in the job openings. And I think part of that has to do with optimism. There is a lot of misplaced optimism among businesses that things are going to get better because we have Trump. Now, that's going to fade relatively quickly once Trump becomes president and things don't get better. In fact, at his press conference again today, Donald Trump again reiterated how things are going to immediately get better. He said it's going to be right away. We're going to have this instant boom, right? Everything's going to magically get better when he's president. That's not going to happen. And when it doesn't happen, then a lot of these job openings may disappear because the businesses are going to lose more workers. So are going to be very disappointed as the data, especially when it comes to inflation and the Fed rate cut. Now, the probability of rate cuts declined today after the release of this hotter than expected inflation number. And as soon as it came out, gold, which was up about $25, sold off. And it still ended up, positive about 13, 14 bucks on the day. The dollar, which was down this morning, and it actually had a big pop yesterday. The dollar rallied. I'll get into that after the break on why the dollar rallied. But the dollar sold off as soon as this hotter than expected inflation numbers came out. But it's not just the inflation numbers themselves that caused the dollar to rally, but it was the reaction in the bond market where the bonds were hitting new lows for the year on this news. And that increase in bond yields is propping up the dollar. But that's not good for the dollar. The currency traders still don't get what's happening. They're still of the opinion that hotter than expected inflation just means the Fed has to fight hard, bullish for the dollar. Well, that's not what it indicates. I've been saying this all along. It doesn't indicate that the Fed has to fight harder to win. It indicates that the Fed has already lost. Inflation won the war. And this is not bullish for the dollar. Inflation is going to keep getting worse. Yes, it may slow down the rate cuts, but the Fed is not going to hike. Even though it never should have cut rates, all 100 basis points were a mistake. They're not going to be able to correct the mistake, because to do that, they're going to look so foolish if they have to do that. But not only do they have to take away all 100 basis points, they need to have rates significantly higher than where they were when they started cutting. There's no way the Fed is going to do that. The only thing they're going to do is slow down the cut. I can't see Powell hiking rate at all, even though he should, but he may not cut. But that's not bullish for the dollar, because if inflation keeps getting worse, and so instead of 2 or 3% inflation that people were expecting, we get 5 or 6 or 7% inflation, and the Fed just keeps rates where they are, that means a huge reduction in real rate. And that is very negative for the dollar, and that is very bullish for gold. And traders just haven't connected the dots yet.
The Federal Reserve is caught in a bind. Its credibility is on the line, and its tools are proving increasingly ineffective. Raising rates too high risks collapsing the fragile economic recovery, while lowering them further exacerbates the very inflation they are trying to contain. This balancing act is akin to walking a tightrope with no safety net. If the Fed stumbles, the fallout will ripple across global markets. The recent 100 basis point rate cuts exemplify this challenge. While the Fed hoped these cuts would stimulate economic growth, they inadvertently signaled to markets that inflation isn't just a temporary concern, it's a systemic issue. Investors are beginning to recognize that inflation has become entrenched, and this realization is fueling demand for real assets like gold and silver. What's even more striking is the disconnect between the Fed's actions and the bond market's reaction. Normally, rate cuts would lead to declining yields, but instead, we've seen the opposite. The 30-year Treasury yield climbing above 4.9%, and the 10-year yield reaching 4.69% indicate that bond investors are skeptical of the Fed's ability to manage inflation. This skepticism is justified as the structural imbalances in the U.S. economy, ballooning debt, rising deficits, and unchecked money printing, are too severe for conventional monetary policy to fix. Commodity prices are surging, and this trend should serve as a wake-up call for anyone who doubts the persistence of inflation. Oil, natural gas, agricultural products, and industrial metals are all experiencing significant price increases. These aren't isolated anomalies. They're harbingers of a broader inflationary wave. Consider the Strategic Petroleum Reserve, SPR, which the Biden administration heavily relied upon to suppress oil prices. This short-term solution provided temporary relief, but left the SPR significantly depleted. Now, with the SPR no longer a viable option, oil prices are poised to rise. This will have a cascading effect on transportation costs, food prices, and virtually every other sector of the economy. For consumers, this means higher bills at the pump and the grocery store. For investors, it underscores the importance of holding assets that can weather inflationary storms. Gold and silver shine in this environment. Unlike fiat currencies, whose value erodes with inflation, precious metals retain their purchasing power. They act as a hedge against rising costs, providing stability in an otherwise volatile market. The US dollar's recent strength might seem like a positive development, but it's a double-edged sword. A strong dollar makes American exports less competitive, widening the trade deficit and putting additional pressure on domestic manufacturers. At the same time, a strong dollar exacerbates the debt burdens of developing countries that have borrowed heavily in dollars. This creates a precarious situation where the dollar's strength is both a symptom and a cause of global economic instability. For individual investors, the dollar's strength is another reason to consider diversifying into gold and silver. Precious metals are not tied to the fate of any single currency. They're universal stores of value that transcend national borders. In times of currency volatility, this universality becomes a significant advantage. Central banks around the world are buying gold at a record pace. Countries like China, Russia, and India are leading the charge, diversifying their reserves away from the dollar. This trend is not just a reaction to inflation, it's a strategic shift in how nations manage their wealth. By holding gold, these countries are reducing their dependence on fiat currencies and insulating themselves from geopolitical risks. For example, China's aggressive gold purchases are part of a broader strategy to challenge the dollar's dominance in global trade. By backing its currency with gold, China could make the yuan more attractive as a reserve currency. Similarly, Russia has quadrupled its gold reserves over the past 15 years, positioning itself as a major player in the global gold market. This central bank gold rush is a clear signal that the financial landscape is shifting. For individual investors, it's an opportunity to align with these macroeconomic trends. By holding gold and silver, you're not just hedging against inflation, you're participating in a global movement toward monetary diversification. While gold often steals the spotlight, silver deserves equal attention. It's not just a precious metal, it's an industrial workhorse. From solar panels to electronics, silver is a critical component in many high-tech applications. This dual role makes silver both a store of value and a growth asset. What's more, silver is currently undervalued relative to gold. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is significantly above its historical average. This suggests that silver has more room to run, especially as industrial demand continues to grow. For investors, this presents a unique opportunity. By adding silver to your portfolio, you can benefit from its potential for price appreciation while also enjoying the stability that comes with holding a tangible asset. Given the current economic climate, here are some practical steps you can take to safeguard your financial future. Invest in physical metals. ETFs and futures contracts are convenient, but come with counterparty risks. Owning physical gold and silver gives you direct control over your assets. Diversify your holdings. Don't put all your eggs in one basket. Consider a mix of gold, silver, and other inflation-resistant assets like real estate and commodities. Stay informed. The financial landscape is constantly evolving. Keep an eye on economic indicators, central bank policies, and geopolitical developments. Adopt a long-term perspective. Precious metals are not get-rich-quick schemes. They're about preserving wealth over time, especially in uncertain economic environments. Consider professional guidance. If you're unsure how to navigate the complexities of the market, consult a financial advisor who specializes in precious metals. The increasing interest in gold and silver is not just about inflation or currency devaluation. It's part of a larger shift in the global financial order. As emerging economies like China and India grow in influence, they're challenging the dollar-centric system that has dominated for decades. Gold and silver are central to this shift, serving as universal assets that transcend geopolitical boundaries. For individual investors, this is a pivotal moment. By understanding these macroeconomic trends and positioning your portfolio accordingly, you can not only protect your wealth, but also capitalize on the opportunities that arise during periods of transition. While gold and silver are powerful tools for preserving wealth, they're not without risks. Prices can be volatile, especially in the short term. It's important to approach these investments with a clear strategy and a long-term perspective. Additionally, the financial markets are complex, and no single asset class can provide complete protection. Diversification is key. By spreading your investments across different asset classes, you can mitigate risks and enhance your overall returns. Inflation is not a passing trend. It's a structural issue that will shape the global economy for years to come. Rising commodity prices, surging bond yields, and central bank gold purchases all point to a prolonged period of economic uncertainty. In this environment, gold and silver are not just safe havens. They're essential tools for preserving wealth. As Peter Schiff often reminds us, the time to act is now. Waiting until the crisis is fully visible means paying a premium for protection. By investing in precious metals today, you can safeguard your financial future and navigate the challenges ahead with confidence. the next decade will likely be defined by profound changes in the global financial system. Those who recognize the value of gold and silver and act accordingly will be better positioned to thrive in this new era. Don't wait for the market to validate what you already know. Take control of your financial destiny and let gold and silver be your guide.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.